What is a QEF election? So this, again, it seems everything is flowing on from the previous question that was posed, in that we've established that investment company or holding company structures, they are not treated in a tax preferred manner by the US tax code. So one of the ways that some people deal with that is making what we call a QEF election under section 1295 of the tax code, where essentially the structure is, it's treated as if in the same manner as a US mutual fund structure. So it mirrors what would have been done had this structure been established domestically as in within the US. So the gains or the distributions retain their character. So if you have capital gains, then it's treated as capital gains on your return when it flows through to your 1040. This is assuming, so this type of election tends to be made at the beginning of your holding company structure. When you fail to do that, if you fail to make this QEF election, then you have these aggressive look-back rules and throwback rules, where because what the PFIC regime seeks to do, just keeping it very, very top line, it basically taxes you on what we call phantom income. So income that has not even been distributed yet. Once there's income within the fund, your investment structure, then even though it didn't get distributed to you as a salary or bonus or dividends or interest, whatever it is, however it is, you're going to pull it out, it is deemed to have done so, and you're going to pay taxes on it. In addition to which, you have holding gains. So for example, if you create a holding company structure and you invest in a startup in Singapore, like many of our clients do, the startup scene is of course very vibrant. And the shares in your startup, the startup that you've invested in, it is appreciated in value with subsequent rounds. With each round is a reevaluation of the share price. And it goes up, but you haven't sold anything. You haven't recognized, there's no recognized gain. You haven't sold anything yet. You need to declare that, increase that appreciation. You need to include that on your tax return. Now, if it is that you do have a holding company or a PFIC structure, and you fail to make those declarations on a year-by-year basis on your tax return, some aggressive throwback rules are invoked, where you're taxed at your highest marginal tax rate, which right now is around 37%. And after the Biden tax increases, one would expect that will go up. So it's the highest marginal tax rate for the prior years, plus interest, plus penalties. So it becomes pretty draconian depending on your situation. So one of the workarounds on this is what we call a QEF election under section 1295. So this is assuming that you've dealt with all the section 1291 gains that we've just discussed, where you made gains or you made income, but you didn't declare it on your tax return in prior years. So you need to clean that up, or you need to cleanse the PFIC of this taint, because it's called a tainted PFIC. So once it's not tainted, you can make that 1295 election. Sometimes you can make it even though it's tainted, but we don't advise it. So you make the 1295 election, and you're able to not comfortably, but in a tax efficient way, declare it on your tax returns on an annual basis. So we work with investors who do have holding company structures or who do have investment structures in Singapore to make that QEF election and prepare the annual statements, because it also requires that you prepare the accounts in a manner that's recognized by the IRS in order to enjoy that benefit. So that is a workaround to this PFIC dilemma or situation that we discussed previously. So we can talk about that offline if you have further questions on it.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htjtax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.